who tracks this space closely from Macquarie, joins us on the phone line from Mumbai to talk about that. Suresh, the title of your report is Chasing Rainbows. So I know you've been skeptical on this pocket for a while. Don't you see any hope because of what was announced on Friday?
See, Sonia, most of the things announced by the government was just a mere encapsulation of what they were already planning to do over the course of last 6 to 12 months. The real problem is that of asset quality, which they have not necessarily addressed in the particular Indradhanush program that they have announced. And that's where my reservations are. I mean, if today an investor wants to buy a PSU bank, the biggest skepticism arises from the quality of the balance sheet that these guys have. And there isn't any confidence at this point in time. And that's where our reservations stem from.
Yeah, I'll just come to the NPL in a minute, Suresh. Morning, and thanks for joining us. Well, there were some incremental positives. One thought, the targets that were given to PSU banks up until recently used to be top-line targets. In fact, up until the 2000s, it used to be balance sheet targets. At least then it got, brought down to revenue targets. Now it's clearly ROE and ROA, profitability targets. Won't that change the DNA of the bankers and the way they think?
Well, to be honest, Lata, if you look at it, just three years before under DK Mittal's tenure, the profitability targets were introduced and an ROA and ROE target was given. And today, if you look at it, 3 years down the line, the ROAs and the ROEs are one of the worst for the public sector banks. So things haven't changed. See, the broader malaise remains in terms of the trade unions that are not incentivized properly. The age-old workforce where productivity levels are low. So merely giving top management ROA and ROE targets, unless and until the incentive systems across the organization is aligned in the right way, will not necessarily result in improvement in ROA and ROE, right? So that's where the reservations again come from.
No, at least you won't have silly things like going and accessing big bulk deposits before March 31st just to bloat your balance sheets. But you think that was already done?
No, so partially it was already done. If you look at it, all these guys had actually reduced bulk deposits very significantly, and that again was a criteria imposed. If I'm not wrong, there was a particular gap of about 15% which was kept on bulk deposits, right? So many banks actually followed that, but their DNA still hasn't changed 3 years down the line. So we have to take, to be honest, these reforms with a big pinch of salt.
You think private sector candidates like, Ravi Venkatesan and Jaykumar coming into BOB is a boon or is it a bane? Because some of these PSU banks could have an HR issue, right? Because a person from a private sector coming into the PSU space?
Well, of course, these guys have been appointed by the government themselves, so the trade unions may have issues, but then at the end of the day, these are confirmed appointments. See, at the margin, let me honestly admit that it is positive, considering that you have, of course, got a good chairman who is going to supervise the board, and of course, a CEO comes from a private sector guy. But then his ability to bring about institutional changes in the bank is something where we have our own skepticism or reservations. Because what happens is that today, if you look at from a return ratio perspective, a BOB has an ROA of about 50 odd basis points. The private sector banks have an ROA of 150. Can that 50 be brought to 150 under the current existing structure? No. So there can be some marginal changes which can be done, which can improve the ROA, but dramatic changes is going to be more driven by more reforms coming from the NPL's front and obviously along the HR issues in the public sector banks, which needs to be addressed in a big way.
No, Suresh, nobody here is arguing that there is a huge revolution in terms of changed parameters. But do you see incremental changes in the sense that, more stress on profitability parameters, perhaps more access to ESOPs and, the bank boards, the bank board bureau, it could mean that we are going to have more professional boards and not, politicians and, government yes-men appointed to the bureau, to the bank boards. There could be a qualitative improvement in, strong boards, like, for instance, an ex-RBI executive director as chairman, just ensuring that political meddling is not there. Aren't these incremental positives?
Lata, the major suggestion by the PJ committee was that the Bank Boards Bureau need to be quite independent. And if you look at the current composition of the Bank Boards Bureau, which has been suggested by the government, it does have 2 to 3 government representatives and an RBI representative. How is it different from the current selection committee? Just trying to do marginal changes from the current selection committee and reterm it as Bank Boards Bureau is is not going to really
There's
resolve
three
the problem.
three external guys and three internal guys. I mean, the internal guys.
Why you need to have government representatives? If you're saying that you want autonomy to be given to all these guys, and you still have government representatives dictating the bank board's bureau, how is it giving autonomy to the entire situation? For all the autonomy that the government has been talking about, as you rightly know, that on the financial inclusion accounts, 95% has been opened by the public sector.
I
banks.
agree.
Yeah,
Yes.
and only and the market share is 70%. So where is the autonomy which is?
No, I
being
agree. That's the big grouse I have every Wednesday. A JS in the banking secretary in the banking secretariat calling out to EDs and reprimanding them for not meeting targets is not the way autonomy is defined in any book.
Even capital raising, Lata, these guys have to go to the government and ask for a permission, right?
Come on, he's a shareholder. I wouldn't doubt that much. As a shareholder, I guess that much right they have. But I am with you that autonomy is still very poorly defined and understood in the Finance Ministry's Financial Services Department, at least the way it's practiced now. But let me come to that NPL issue that you raised.
Correct.
You know, there is constant reference from the finance minister that state governments should not think that the losses of DISCOMs can be endlessly funded by banks. Now, that is the right stance to take. As well, we understand Piyush Goyal has met a couple of chief ministers with respect to the troubles at their DISCOMs. Isn't all this in the right direction? Maybe in a few months we are going to see some of these resolved. Probably, higher tariffs or more control over T&D losses?
You know, I'm just worried whether this just gets stuck up in the bureaucratic middle or mess. Because what happens is that you try to take consensus building amongst different ministries, and every ministry will try to extract their own pound of flesh. So obviously, the power minister will have its own set of agenda and objectives, whereby it would demand more financing from banks, and banks have to accede too. So, so the problem really is discipline enforcement at various levels, which is where it's lacking at this point in time. We really need to see the framework of the revised set of restructuring in case they are deciding to do. But the problem here is if that is going to happen by more financing and again laxity in rules and regulations, then clearly banks are going to be the sufferers.
Yes. Any forbearance from the Reserve Bank is going to be taken very badly. One hopes that they are allowed to stand pat.
Yeah. So we need to really get a more. How do you solve a global commodity sector like steel, right? I mean, hiking import duty by 2.5% is quite meaningless in the sense it is not going to impact the sector in a big way. So there are still quite a lot of issues in these sectors, and we need to get a greater amount of clarity, and that's the reason we don't think necessarily that that asset quality situation is improving. And one of the most important indicators which everybody needs to track at this point in time is credit growth, because if the system actually is not growing and banks are only lending at 9% levels, which is lower than a nominal GDP running at 12%, it clearly means there are serious issues. There is no demand recovery in the system. Partially it has to do with capitalization of the public sector banks. A large also has to do with the stress state of the balance sheets of corporates, right? And the ability of the banks to take more risk on the balance sheet.
All right, Suresh, we take your skepticism with both hands, but we've run out of time and we're going to invite